Hello traders, welcome. We are live. It's 6 p.m. EST, so we are starting this webinar. The plan today is checking the live markets, but also on the first part of the webinar, I want to check some basics about the Elliott Wave theory to have some foundation for the setups and some understanding of the basics of Elliott Wave theory. The Elliott Wave theory is something that is not new, has been here in the technical analysis world for a while, and is actually something that could be extremely simple. So it depends on how deep you want to go in the Elliott Wave theory, but at the end, the logic and the result is gonna be the same. So the main plan with Elliott Wave is to find the impulse. The impulse is a 5-wave sequence. So when we are talking about the impulsive legs, we talk and we label them with numbers. So the plan is to have a 1, 2, 3, 4, and 5, and of course from this pattern we can start working with different things. We can start, for example, following the trend, finding the trades after the corrective waves, or we can try to go against the trend after the impulsive legs. So the basic Elliott Wave pattern, the impulse, is going to have three impulse. Inside wave 1, we're going to have another impulse. Inside wave 3, we are going to have another impulse. Inside wave 5, we're going to have another impulse. And in the corrective waves, we are going to have corrective patterns. The corrective pattern in the Elliott Wave theory is just a 3-wave sequence or a multiple of 3. So the plan with the Elliott Wave theory is to read supply and demand on the market. That's the plan. So the first step when we are building a wave count is we need to define where we are in this scheme. In which part of the pattern we are currently to navigate to the next point. Also, we work with a distribution process and accumulation at the bottoms. So the distribution is going to happen at the top, and it happens after the wave 3. We have something that I call the stop in action, that is the wave 4, and then we have the wave 5, and that's the last leg. So one of the setups, one of my favorite setups, is when we have wave 5 and the price returns and closes under the wave 3. That's an entry, for example. So always we need to check the distance between the peaks, the highs. When that distance is decreasing, we are likely to be in wave 5, and we need to start getting ready to take counter trend trades, for example. But once the impulse is done, the next leg that happens is a corrective wave. So it's going to be an ABC pattern. Let me change here the color so we have everything right. Okay, there we go. So then the next pattern after the impulse is the corrective wave, that is an ABC, is a zigzag. So to keep things extremely simple, the basic Elliott Wave pattern is gonna have 5 waves that we are going to call the impulse, and 3 waves against that leg that we are going to call the corrective wave. That's it. That's the basics of the Elliott Wave theory. Pretty simple, right? Pretty simple. The other important aspect is that at the top, we look for price to finish wave 5 and close longs if we are long, and maybe take shorts depending on the structure, and the same after the ABC. So once we have the C leg happening and then the price returns above A, we can go long. So as you can see, the rejection of a level at the end of the corrective or at the top of the market is what is going to give us the trades. And that's the job that we are going to do today. We're going to find some trades here in the live markets, and we are going to plan some setups for the upcoming days. But we are going to use this setup. That's going to be our main setup, to have the rejections, to have the setups, and to have the entries. When we are trading, there are 3 things we need to master. The first one is the market structure, is to find where we are and where we are likely to go in the future. So it's the market structure, is the analysis, and for understanding the structure, I use Elliott Wave. The second part of the process is finding the entry. So to trigger the trade, we are applying price action. So could be these rejections, right? That's going to be our main entry. We can add other things if we like, other techniques to validate the end of the waves, but everything around this concept. And the third part of the process is managing the business. So managing the business is understanding the risk. Not all the trades are going to work, of course. There are good weeks, there are bad weeks, there are good days, there are bad days. But the risk is key to survive. I like to trade with no more than 1% of the account. Book partial profits once I reach 1-to-1 risk-reward ratio. Well, and other things that we are going to check in this class as well. The other important aspect is managing the psychology of the trader psychology, because a lot of traders have huge issues here. They are not doing they are not applying the same strategy every day. They use a different strategy every day. They don't wait for the setups. They don't look for validations. They ignore the analysis, and a huge list of little troubles that, of course, are going to impact the business management. And of course, in order to have a good trading, we need to put together these 3 concepts in order to be consistent. So that's our methodology, and today we are going to look for examples covering these 3 aspects. So analysis, market structure. Here we can also add institutional cycles. We can add other tools. We can add momentum analysis, all the things related with analysis. Entry, pure price action, because if we look for indicators, if we wait for indicators to trigger a trade, the entry is going to be extremely late, and we need to have a good execution. And the third part is pretty personal, and each case is different. But of course, we can give some advice and some little things to start changing your trading. So this is the process, and this is what we also do here in the Elliott Wave Street membership on a daily basis, working on those individual aspects. But today we are going to work with the Elliott Wave theory. And I'm going to start today with the euro. the plan, as we were mentioning, the first step in order to find the setup is finding where we are in terms of the structure, right? So I was drawing the market structure that is 1, 2, 3, 4, 5. So to keep things extremely simple, here we have our 1, 2, 3, 4, and we are in the wave 5. As you can see, actually, let me hide some of these waves so you can see that better. We are in the last leg of the impulse. So, of course, buying at this stage is crazy, right? That's something that we are not going to buy at the market extremes. That's also extremely important to understand. Let me go back to my drawing here for a second, because imagine that the price has an average that has a midline. And if we are traders, as traders, we buy at the lows, we buy at the lows, we buy at the lows, and we sell at the highs, and we sell at the highs, and we sell at the highs. That's the basic business model when we are trading. But if you think a little bit deeper, all the retail techniques are developed to do the opposite. Let me explain. For example, let's say that you are working with a moving average system, and the moving average is moving here, it's moving here, and then you add another moving average to give you the signal. So comes here, crosses, and crosses. So this is just a little example of how retail traders are finding their setups, and this could be a 1 minute chart or it could be a daily chart, it doesn't matter. So some traders wait for the moving average to cross over. So this will be the buy trade for the retail trader. Sometimes it's higher, sometimes it crosses later, right? The sell trade will be here. Here will be the sell trade of the retail trader, right? The buy trade will be, say, somewhere here, right, when it crosses. And you can see that that's not the plan. The plan, my point, is that we need to focus on buying here, selling, buying. That's it. Of course, we need to add the signal. We need to add a little bit more. That's what we are going to develop today. But it's important to filter out the buy trade. So something that we are not going to try to do here is buying at the top of a wave 5. It's like the Bitcoin traders a few years ago, when the Bitcoin was trading at $65,000. They were buying. That's crazy, right? So never, as traders, we can buy at the market extreme, at the upper extreme. Doesn't have any sense. So that's one of the many benefits of the Elliott Wave theory, that it starts helping us drawing this structure, and we can use the structure to filter out if we should buy, we should sell, and then we just find the trade. So look, here is the structure. So clearly we are in the selling area. We are not going long here. We are not going long here. If we were looking for a buy trade, of course, those areas, not saying that that was a real trade, just the area. Of course, the area was here, or here, or here, or here, at the extreme. Selling could be here, could be here, could be here, could be here, and here, where we are in the live market. So the next step in this process is drilling down, is understanding what's happening inside to sell, to have the best timing, and to have a small stop loss when we start finding the trade. That's the next step. And once we have the completion of wave 1, and the price starts dropping for the wave 2, we will see during the road if we go long, if we close the short trade, or if we just keep the trade in case that the price starts collapsing. Sometimes the price, instead of building the corrective, could start moving down aggressively and not showing a corrective behavior. And if we are short from the top, well, we just hold the trade. So of course, we need to watch the price and see how it's developing. If it's developing in a 3-wave sequence and is rejecting, we can go long. If not, we just hold the trade. All right. So look, the markets are going to make two processes all the time. They are going to do accumulation. So accumulation is happening at the bottom of the market. So this is an accumulation process. The accumulation works by rejecting. This could be a random level. I believe that it's impossible to tell where the price is going to reject. We don't have a clue, right? And when the price rejects, we can have different schemes of accumulation. One is that the price makes a low, that's my favorite, and rejects again. But sometimes, like here on the euro, the price is so strong, the demand is so strong, that can make the low and pushes higher, and tries again and pushes higher. So of course, this is extremely bullish. Then it breakouts the last retrace. That's a breakout of a structure, which is extremely important. And then is the bull trend. So that's the accumulation, and the distribution process is going to happen at the top. So the first step in the distribution process is price moving down, going sideways. And as you can see, that is exactly what is happening here on the euro. We have the price moving sideways. So that is stop in action. I call it the stop in action because it's the action that stops the price from trending. It was moving up and eventually it stops trending and it starts moving sideways. So that stop in action formation is the first step for finding the end of the impulse, for the leg down or for the leg up. So let's develop more on lower time frames, because the 4-hour chart, the hourly chart are the time frames that are going to help us to understand this better. So right here on the lower time frames, we have this area where price has been stopping from bullish, and is the first step of the distribution process. During this process, there is an institutional cycle here inside, because right here we have a stops. So this is a stops area. When someone, an institution, a retail trader, a small, medium institution, is losing money, that money that the retail trader is losing is not disappearing, right? Is not going out to the space and disappearing from this planet. Of course, it doesn't work like that. When someone is losing, that money is coming to the market maker, to the dealer, or to the big guy. This participant has so many names. In the volume profile, in the market profile, is called the other time frame trader. Also, it's the dealer, is the market maker, is the big guy. But at the end, it's a set of institutions like JP Morgan, Goldman Sachs, Citibank, right? The big institutions. And all the money, the stats that 9 out of 10 traders are losing their money. Well, for the big guy, the business is the other way, right? They are making 9 out of 10 because the losses from these participants are going to his pocket. So it's a great business for the big guy. So mainly, and of course you can learn more with us in the membership because I explain this daily with different examples and everything. But mainly the plan is that if we have here stops, the stops from who? Well, someone that sell here or someone that sell here. I'm just picking random levels, sell here or sell here or sell here or sell here. Some traders sell at the extreme, right? And leave their protective stop loss here. Some others book partial profits. Well, there are so many different things, but the majority of traders are greedy and they want more and they want to have a big leg down. So they are leaving their stops right there. Also, we have here pending orders. We have limit orders for sellers. We have buy stop orders for buyers. Well, a lot of liquidity is happening here at this area. So the big guy withdraws the supply, and that makes that the price moves higher to capture all the stops. So this price right here is capturing all the stops from the weak sellers. And some traders are buying here. Some traders are going long, and that's something that you should never do in your life, buying at the upper extreme. But some traders will go long because the price breaks up resistance and they leave stops here or probably here, right? There are so many strategies. And of course, the plan of this cycle is to take out all these stops and try to shake out the market as many swings they can and distribute at the top and have a leg down to take out the stops from this area. So the plan of the big guy is to take out liquidity from those who short the market. Now they are doing that. And then they have another problem. The ones that are long, they need to clean up this liquidity as well. So of course, this process requires time and requires a lot of understanding of what's going on. So as retail traders, we can't trade as the big guy, right? That's impossible. The big guy trades hedging. The big guy uses the options market as well to hedge. They usually don't use a stop loss. They are commercials. So their business is completely different. But what we can do, we can understand what is happening and we can try to follow what the big guy is doing. Is the only way to make money in these markets. Is the only way. So let's drill down to the hourly chart, and because markets are fractal, this is going to be another distribution process in this area. So as we can see, the price was trending, was moving up, was pushing higher, and eventually at a random level, let's say, the price rejects and starts building this corrective pattern. So this corrective pattern is going to bring sellers, is going to take them out. Look, they already clean up the liquidity. And now what I'm thinking, of course, this is going to be a first entry. This is a first entry, of course, this rejection. So someone trying to sell the euro after this red candle on the hourly chart will go short and that will be its first attempt. But I believe that what could be happening here is something a little bit more complex, because imagine the price coming down here where I have this W, rejecting, moving up and taking out the stops here. Tomorrow we have the CPI. So pushing higher, let's say to the 108, to take out as many stops as they can, to bring more buyers that go into the market long at the market extreme, and eventually rejecting this area, showing a nice red candle. If that happens during the news, we are not going to be able to trade it, right? It's going to be impossible because it's so fast that the stop loss is gonna be heated. But what if tomorrow after the news, let's say that we have a lot of volatility, tails and everything, and we have the supply happening here, let's say something like that, and then the price makes the retrace as an ABC. That's going to be the sell trade, because we will have all the supply, wave 1, we will have all the corrective wave for wave 2, and that's where we can trigger, and that's where we can have the trade. Look, here is another example. Price moves down fast. Okay, price makes the stop in action. Right? It's like this price that we have here is like the one that we have here. Of course, the stop in action is going to have different patterns, different shapes. Price takes out liquidity. So it comes down here, rejects. That could be a buy trade. If we were live there, that could be a buy trade. Doesn't work, rejects, and we have another buy trade. Always at the extreme, right? So the logic is that the price is taking out the stops that are here, is absorbing this liquidity, and then is rejecting. That's the setup, right? And between the two highs, let's say, we need to have a distance, a significant distance. So this A that I have here, don't worry about the labels, but that A is going to be the same as this A that I have here. The stop in action formation, all this price action that we have here, will be this price happening here that I believe is not done yet, right? And the leg up here will be this leg down here. You see? And what most retail traders will try to do here is going long, because it's breaking resistance, because whatever, right? Because the news, whatever. But something that we shouldn't be trying to do is buying. Only selling if we have supply. Because if the price is flying above this area with huge candles pushing higher, of course, same here, right? Same here at the bottom. If the price starts trending down with huge candles, we are not going long. We need to have the rejection. Rejection means that demand is entering the market, and you are not alone. So, of course, if we have here the rejection at this area, that's going to be the trade. Another example, look at this A. Look at this B. Look at this C. So we have the stop in action, we have the high, we have the price rejecting, taking out all the stops, and that's the signal. So that's the process. And we can use Elliott Wave to understand where we are, because we're coming from the daily chart, and we come here and we plan the trade. So now let's have a look at other instruments a little bit faster. I was taking a lot of time here because I wanted to explain the market structure. But let's continue with another one that is really interesting, dollar yen. On the dollar yen, we are looking for a leg down. Look at this thing. The price makes the impulse down as a wave 1. right here rejects. So the stopping action formation on this pattern is the B. So I was telling my clients today in the morning, the stopping action in Elliott Wave is going to be the wave 4, the wave B, and the wave X. That's it. Those are the legs before the trigger. Look, the price comes up here, rejects, and here we go. The next level of liquidity is here, the previous low. So here can happen two things. One, the price could break down aggressively this area. That's what I'm looking for, like a big and huge sell-off, right? A huge sell-off here, a wave 3 down, like 500 points or more fast to the downside. That's the plan. Or if the price comes here and rejects, oh, we have to be careful because it's rejecting this area, and that's something that we don't want to see during the wave 3. But of course, if we are short from this area, we are going to be fine. So when the market is sideways, say that the market is moving down, it's a wave 1, whatever, and it's bouncing here, and this is extremely important. If your bias is bullish, you have to buy at the low. You have to buy at the low. If your bias is bearish, as is my bias here on the dollar yen, we have to sell at the highs. Sometimes we have to try several times, 2 or 3 times, at the rejections, right? But never in your life try to do the opposite. Never try to go long here or go short here. That's crazy. That's trading like that, selling here or selling here, right, is going to give you a huge advantage. Let's suppose that we need another leg up because news come later and the price moves to the other side. That can happen, right? But if you shorted here at the market extreme and you have a tiny stop loss, at this stage, you already have a 1-to-1 risk-reward ratio. If this is the risk and this is the benefit so far, right? Enough to book some partial profits, enough to protect the trade. But imagine someone triggering here. Let's talk about the other extreme. When the price breaks down, well, sometimes he can be lucky and he can have a big wave 3 as the one we're expecting, but the stop of this participant, some of them leave the stop here, right, or here, so it's going to be a huge stop. And the problem with those huge stops is that it's going to be extremely complex to make money. It's going to be almost impossible to make money because in order to reach a 1-to-1, you need to have a 200, 100 pip move. So I believe that the stops for swings should be around 30 points, sometimes 40 points, and that's it. But 100 points, 200 points, that's crazy. And of course, for day trading, for scalping, with 20 points is more than enough to let the price move, but having a fast risk-reward ratio is important as well. So that's a nice setup that we are following in the membership as well. Let's move to the S&P. The S&P. So let's have a look at the daily chart. So I can show you what I'm working on here. All right. So the S&P last year, this is a daily chart, was pushing down and was pushing down and was pushing down. 20% or over 20% of losses last year on the S&P. All right. So the next question is if the S&P is ready to move back to the almost 5,000 area, or if the S&P is going to drop back to the 3,400, whatever, right? That's the big question. Of course, nobody in this world knows the answer. Can be the biggest bank of the world, can be the smartest trader on the world. Nobody in this world knows with a 100% of probability if the next leg on the S&P is going to be down or up. So let's start from there. So you don't have to worry about it. And I'm going to show you why. As traders, we don't have to worry about it. Like, we don't care at the end as traders. As investors, as long-term investors, of course, it's different, right? Because the investor wants to buy and hold. And of course, with technical analysis, he can perform that action as well. But as traders, as active traders, we shouldn't be worried if the next level is the low or the high. Because listen, if the S&P makes another leg down, and I'm looking for that, to have the price moving down here, where I have my A, and let's suppose that the market starts developing the leg down, let's say like something like this. And here the candles are smaller. And then if we compare with a momentum indicator, let's say the MACD, we have divergence. And once we're there, we have a nice green candle happening here. Let's say that's going to be a beautiful setup, right? If something like that happens, because we can go long. The long-term investor can go long as well. And we are going to have a bullish bias. So from there, all the corrective waves are going to go long, corrective wave to go long, right? Until we reach this area. And of course, the plan is to have fast candles. So we will continue doing the same, buying. And once we cross the 4,800, we will start being careful because we will be at the market extreme. Now, what if price, instead of moving down slowly, let me change the color here, let's go with a blue so you can see it better. What if we start seeing this type of candles? Are we going to try to go long? Of course not. Price is going down fast. There is no setup. There is no demand. When we have tiny candles moving down, is because demand is entering the market. When we have huge candles moving down, is because there is no demand. And when you try to go long here, after that huge candle, you are alone. You are fighting with a huge bank, right? So it's crazy. So in that case, the market is going to make a lower low, right? So what if we sell the B wave on lower time frames as the main bias, and we target the previous low where the wave A finished? If the price comes there and rejects, we close the short, we go long. If the price successfully breaks down, we keep the short trade. Extremely simple. So of course, the next step is moving to lower time frames to find how we can find the end of this B. And that's going to be the tricky part. So let's do it. Let's move to lower time frames and let's find the way to trade the B wave. So let me go directly to the hourly chart. On the hourly chart, here we have the price building a corrective wave. I believe it's a corrective wave. So this area is important, was sideways, price breaks up, makes like another structure here. And today I was trying to find a sell trade. I was thinking that this was the top of B and that this was the first leg for the leg down, was pretty strong. And I was looking, finding some rejection here. My bias was short to have a leg down. That was what I was thinking today in the morning and yesterday. But the price instead pushes higher to take out the stops above this high. Of course, sometimes we are going to have the type of situation, right? Not always we are going to have a good setup, but now we're here. And the next question, what should we do right now? We can't buy, right? It would be crazy buying at the worst price, right? If someone was bullish, should, I don't know, go long here or go long here, or trying to capture any extreme, right? Not the opposite extreme. We are in a selling area. We are in a selling area. But the question is how we can sell, how we can plan the trade. So let me zoom in a little bit more and let me add one of my favorite indicators is the MACD. I have a complete course inside the membership about the MACD, and you can use it with any momentum indicator, RSI or stochastics or awesome oscillator, anything that you like. Of course, the indicators are the same price. In the MACD we have the same price, but it's showing the price in a different way. So it's also price action. Signals coming from indicators are terrible, right? The signals from the indicators are lag, they fail all the time. So I don't like to use the indicator to find trades, but I'd like to use the indicator to read the momentum. Because now that we are here, the price is moving up, right? That's a fact. That's not subjective. We have this high, and right now we have a hard high. Okay, but look what now the MACD is doing. So far is doing the opposite. So that's not a trading signal. You know, I know some traders that say, oh, that's a sell trade because we have a divergence, and that's a huge mistake to apply the MACD like that. It's going to fail most of the times. But what this is telling in terms of supply and demand is that price was moving faster in this leg. And in this leg is moving higher, but is lower. Slower means that an opposite force is not letting the price move as fast as it was moving before. And that opposite force is called supply. So what this is telling is that supply was weaker during this MACD, and supply is stronger on this MACD. So someone is selling, someone is absorbing all the buy orders. So all the traders, I believe that all the traders that are going long here, let's say at this breakout, something that we shouldn't do in our lives, buying at the highs, they are trapped. Where do you think they have their stops? Well, that's easy, right? It should be here, probably, right? Some of them will have the stops here. Some of them will have the stops here. All right. So what if the big guy lets the price make the distribution process here, completes the pattern to bring a lot of buyers at the extreme, and then pushes the price down fast to capture all the stops? That makes sense, right? So let's continue drilling down to create our trading plan. Look, on the 15-minute chart, now we're checking this wave 3. Oh, let me change my color. This wave 3 is the one that we are checking on this time frame. On this time frame, the MACD is the strongest. That's one characteristic of wave 3. Wave 3 is the strongest of the cycle. So, because markets are fractal, we can come down here to the lower time frames. We wait for the stop in action. We don't know where wave 3 is going to be done. Could be here, could be higher. We don't care. But once wave 3 is done, it's going to build something sideways or something a little bit sharp, whatever. And it's going to create a box. All right. The MACD, of course, is going to make some sort of retrace here during that process. Right? Then the price should climb and take out the stops from early sellers. The MACD to move higher but lower than the previous height, so that's divergent on the 15-minute chart, something that we don't have. The cycle is pretty strong. And right here, traders, will be the aggressive entry. Right there, that's the sell trade. Right there. That's the aggressive entry. The conservative entry is when we have more candles developing to the downside, breaking a structure. Then this will be wave 1. And after that, we can look for a corrective wave 2. That should be corrective, small candles, losing momentum, nothing too aggressive. And at the end of 2 is the second entry. Some traders prefer the aggressive. Some others look for the conservative. Some others make some trades here, and then they add to the position here. Right? There are different things that we can work around this idea. So this is the setup. Now, what happened if tomorrow the CPI comes with a result, better, worse, whatever, and creates a candle here on the S&P, let's say, a candle that pushes higher to the 4,300 area? Well, we didn't sell it. Right? That's it. That's the worst thing can happen. That's it. And if we trigger here, of course, should be after the news, because those news are extremely, extremely complex in terms of volatility. The price moves so fast, all the up and down, that it's impossible to survive day trading or scalping. Even if we are right, the volatility, the noise is huge, and it's going to take us out. Right? So we wait for the signal or the wave 2, whatever, and we start the process. But we have a clear picture, thanks to the Elliott Wave theory on the hourly chart, trying to find out, in terms of the structure, what the big guy is planning here. Let's have a look at another market, gold. Gold, it seems that our wave 1 is done. So here we have the rejection, as you can see. Right? So that's entry number 1. Let me zoom in a little bit more so you don't have to make a big effort. So as you can see, that's a rejection. Right? It's objective. Look at the stop in action. Price moving sideways. Price moves up. Price rejects here. Could be an entry. I prefer when the price explores a little bit more. Right? Those are just little details that you can learn with experience using this price action technique that I develop. But when the price rejects, this is the candle on the hourly chart. Right? And this is wave 1. So that's the aggressive entry. And here comes the second chance for wave 2. So this is wave 1. This is wave 2. And the plan is to have then wave 3. A powerful wave 3 after that. So the next step here, we can trade it here or the 15 or the 5-minute chart if we like. But I believe here will be fine. Candles moving here, better if they are small candles, right? If we go to lower time frames, we can use a MACD, we can use an indicator to confirm divergence between the 2 points. And then, when we have the price selling off here, showing supply, that's the second validation. So you can see that we are doing the same that we did here, but a little bit smaller, let's say, for the corrective too, right? It's like a copy and paste. Here was the signal candle, here will be the signal candle. That's it. Pretty simple. What if the price departs up and makes a huge candle up? Can that happen? Of course can happen, and sometimes it's going to happen. But let's see what can happen in terms of the trade. If we trigger here, with this leg down is enough to book some profits. I like to use a rule that once the price reaches the 1-to-1 risk-reward ratio, I like to book partial profits, 50% of the trade. So if I'm trading with 10 positions, I close 5. I leave the other 5 with the original stop loss above the high. So in the worst case scenario on that trade is going to be a break even, because we take out half at the 1-to-1, right? So the worst scenario is a break even if that happens. And of course, we are not going to sell it. But if supply enters here, we have the trade, we have the setup. So this process can be repeated and repeated and repeated in different time frames. Some trades are going to work, some other trades are not going to work. At the end, the ones that work are going to make more money because the risk reward is excellent when we trade like that. Let's have a look at another one, the oil. Oil, this is WTI or CL. Let me share with you my experience this week on oil. I went short at this rejection on oil. So I have a 3-wave sequence, as you can see, and I started to sell oil at this area. Then the price moves down nicely. This was a beautiful leg, enough to book some profits. After that, the price makes another move up, another leg down, so we started to see lower lows, right? Lower lows, higher lows. And I was thinking that we were going to have some sort of 2 here and a 3 down here. But the price did this breakout. Look at the size of that candle. Wow. And makes the high right here. Now, look at the tiny candles happening here. That's supply. That's evidence of supply. Because if supply is not present, the candles will continue being huge. And it's not happening that. So we can confirm this plan using the MACD on a lower time frame. We can go to a 15 or a 5-minute chart. There we go. So look, here on the 5-minute chart, this is the stop in action formation. So the same thing, right? It's like repeating the same process. It could be that this is the one, or it could be that the price makes another one here. We don't care, right? But once the price moves above this area, where the stops, where the liquidity is, and is not finding demand and instead finds supply, and we have little candles, and we have a nice candle showing up here, that's the first entry. And we are going to have divergence, right? It's pretty simple. So it's the plan is to repeat and repeat the process. Let's have a look at another example. Let's have a look at an individual stock. Let's work with Apple here. So guess what? It's going to be the same. So let's start here from the left. What is going on here? The price was going down and eventually it started to move sideways. So what is happening here? Well, could be that the big guy is doing his accumulation, right? Starting the accumulation. Could be. We don't know that yet. Could be that it's just booking profits from the leg down. Okay. The price drops and starts the stop hunting under the low right here. Right here. Okay. We don't have anything, right? The price can continue pushing down. Okay, let's wait. Then we have this gap. Don't forget that the gap is actually a candle, right? And that's the confirmation. Someone says, oh, no, too tough. I don't feel comfortable buying at the extreme because that's going against the trend. Okay, no problem. Wait for wave 1. This is wave 1. Wait for wave 2. That's a 3-wave sequence. Look for the rejection. And that could be the trigger candle. This green one here, right? Showing, waiting for demand. Okay. And what is the next step then? Well, we have a 5-wave sequence. So, right here, the wave 5 is going to be done soon. It's going to be over soon. Right? And this area is where is likely the price to finish. Wave 1. If that's correct, and we have the price absorbing orders here and showing the leg down, that's it. That's the confirmation that wave 1 is done. If you went long here, you should close your trade here. If you went long here, you should close your trade here, right? And here comes the next trade. So the next trade in this process is this wave 2. It's fantastic, right? How the markets work. 1, 2, 3, 4, 5. The price finish 5, rejects, closes under 3 again. It starts wave 2. If wave 2 shows a clear corrective wave losing momentum, and we have a rejection, that's the entry point. Look that I'm not using Fibonacci levels or things that are extremely subjective, right? I don't know where the wave 2 is going to be is going to be done. Could be here, could be lower, I don't care. I need to see the price losing momentum, waves A, B, and C, and after C, price closing above A. That's it. My stop is here, just in case. Sometimes it's going to work, sometimes it's not going to work. And the plan is to capture a big wave 3 up. On the other hand, price starts selling off. Woo, and creates this candle. I'm not going to go long after that candle, but the beginner will add Fibonacci levels all the way, right? And the price hits 50%. So the beginner will say, okay, the price hits 50%, is my time to go long. And the beginner jumps and leaves a protective stop loss here. What do you think is going to happen? It's going to take out that participant. The price is going to continue lower. It's going to make a lower low. It's going to take out these stops under the low, and it's going to crush that participant. That participant will say, oh, the Elliott Wave theory doesn't work. It's a scam, right? It's a scam because it's a waste of time. Why the Elliott Wave has been used by professional traders since the 40s, since 1940s, since 1950s. Why so many years the Elliott Wave theory has been a tool in technical analysis if it doesn't work? Well, who can tell him, right? Who can tell him that he's not reading supply and demand? And no matter what analysis you're doing, if you don't master reading supply and demand and you go long after huge red candles, right? That's not going to work. Look at this example here. Imagine someone thinking that this is wave 1 and we're going to have a wave 2, right? And the price starts selling off like that. Oh, I'm going to buy it. I'm going to buy that candle because it's the wave 2. Yeah, sure. It's going to take you out. Of course, look at the momentum. When you go long after a huge candle like that one, you are alone. You are the only one in this planet going long. Try to see it like that. Never in your life trade against strong hands, strong participants, whatever name you want to call them. The big guy, whatever name you want to call them. Withdraw of liquidity, any name. But the fact is that when you trade against those huge candles, most of the times you're going to lose money. Try the other way. Try to find weak participants. Look at this example. We have a nice leg down. I'm talking here. We have price moving up with tiny candles. Look at that thing. Oh, tiny, tiny. Rejection. Okay, that could be interesting. Right? So that's a huge difference when you are trading with price action. Reading supply and demand all the time. And even if you have a wave count, even if you have a lot of knowledge, sometimes the market is not going to do what you are thinking, what you are expecting. And those times you have a little loss. And that's it. It's simple. It's part of the business. But when the market does what you are expecting, that's where you can make a lot of money, recover losses, and have some good profits. That's the process. That's it. It's actually pretty simple. All right, traders. So that's the class today. If you want to continue this process, we have a fantastic membership on Elliott Wave Street. So right here on our website, elliottwavestreet.com, on the membership tab, you can sign up. So here we have the Forex, the stocks, or the full access membership. You can trial any of these memberships for just $19 a whole month and get these updated analysis every day, Monday to Friday. I publish a daily video explaining the strategies, the charts, and an afternoon report with the updated wave count on the S&P. And of course on the morning report, all the markets. And you will get access to the education, where we have the Elliott Wave Crash course, where we have the Volume Profile course, where we have the MACD course and other fantastic courses inside that you can watch. So you can sign up right now. Visit elliottwavestreet.com/membership and activate your membership. You will get immediate access to the reports, to the past reports, to the today's reports, and you will get the daily report tomorrow in the morning. All right, so here we have a question. Sometimes the fifth wave fails to make high. Yeah, that's called the truncated wave. So sometimes the price, let's say, is moving down 1, 2, 3, 4, 5, and let's say that 5 finished before the end of 3. That's the truncated wave 5. So you don't trade it. I prefer not to trade. That's extremely rare. It's not happening often. When it happens, we are waiting for the low to buy. But let's say that the price departs from here, and we were waiting for the price to make the low, but didn't happen. Then, oh, okay, we didn't trigger the trade. That's fine. But as a general rule, I recommend always waiting for the wave 5 pushing under 3. That's the complete auction. When this happens, it's a failed auction, and it's difficult to trade. So be careful with that setup, and trust me, 98% of the times, the impulse is gonna be with the wave 5 moving above 3, so you don't have to worry about it. Yeah. So I'm gonna post the recording in the YouTube channel, also on the website, so you can check the recording and check the concepts again. And also, you can sign up for our fantastic membership to get the live market analysis and more every day. Thank you very much, traders, for being here. As always, it's a pleasure. Please have a great start of your year. Be careful with the CPI report tomorrow. Anything can happen, but we have to get ready to make some good money. So have a good night, good evening, take care, and bye-bye.